I'm Alan Kenny with REIT.com, and we're here in Washington, D.C. at NAREIT's Washington Leadership Forum. Joining me is Robert Lehman, REIT Practice Leader with Ernst & Young. Robert, what are some of the economic indicators, aside from jobs, that investors and the REIT industry need to be looking at to kind of get a better idea of when we'll see a more expansive recovery?
I think, Alan, it's a good question. The jobs issue itself is just a small indicator of confidence. It's all about economically confident. How confident are consumers? How confident are businesses? Businesses will add jobs if they're confident, consumers will spend. One of the things that's really holding us down right now is housing. Housing is a huge economic indicator of this country. A tremendous amount of our gross domestic product comes from people buying new homes, renovating homes, and frankly just moving around the country because they create jobs, they create economics. So I wouldn't look to just jobs as sole measure. I would be looking also at consumer confidence. Are people willing to spend?
And how about development? Do you think we'll see that ramping up anytime soon?
Development's a tough question right now. In order for development to move forward, first we have to fill up the vacancies we have. And in many of the property classes, what we have right now is a larger than historic vacancy level. What's happened is money's now flowing into the major markets on the coast, LA, New York, Boston, San Francisco. What we need to see is those areas to lower their vacancy levels, increase rents, and then when that happens, businesses will be forced to get a better economic deal to move to some of our tertiary markets to therefore lower their vacancy rates. When that happens, only then can we have true, real development to make it economic. Right now, the replacement cost, meaning today's dollars to build a building, is in excess of what it would cost to buy some of these properties in other areas. So I think before we have a true expansion, meaning construction development, in our market, we're first going to have to address this issue of vacancies in the secondary markets.
And then finally, another issue that's getting a lot of play right now is the convergence of global financial reporting standards. What are some of the implications there for REITs? As
standards converge, then any investor anywhere in the world could look at any company based anywhere in the world and will have a clear, transparent, consistent set of rules to review. That's a good thing. The difficult part is how do you come about that? We have different standard setters in the world, mostly the international standards in the US right now that are used in most of the world. A few people still have other standards, but those do have some differences and they matter a lot to real estate and they matter a lot to REITs. What really right now, the one that's the hottest I would think for the REIT industry to address is the potential to be similar to an investment company, in essence mark to market. There's some beautiful elements in that that will be very beneficial to REITs, but there are other things that are going to cause confusion. So I think when all the standards are said and done and we do have a reconciliation, it will be a good thing. But the process itself is slow and it needs to go slow because we can't allow it to move fast because we don't want a general standard to be passed that would have a broad implication that would not appropriately show the REIT industry.
All right, well thank you very much for your time, Robert.
You're welcome.
And for more on this and other REIT news and analysis, check out REIT.com.